I would like to share our experience on how do we perform stress testing of the banks. It is a little bit different from probably what you've heard so far. And at the same time, it is connected with valuation in banking sphere also. So let me start with a general remark on essence of the stress testing. So why do we need stress test? It allows us to estimate the impact of some plausible but severe and adverse events on the financials of the bank and any other institution, unit, industry, whatever you would like to test. And why is it important? Because usually not everything can be measured based on historical experience. Sometimes we do not have enough data in past in order to evaluate the impact of really severe events. Each crisis is not the same as the previous was one, and that's why stress test is so popular, because it allows you to combine such events that bring crisis in place for the bank, for the institution, for any kind of institutions, not only for banks, and test whether your company, bank, can resist this kind of adverse movements. And it is necessary for supervisors. That's why it's so popular among all the supervisors all around the world. You can look through the websites of, for example, Fed and the European Central Bank and the Bank of England, and see all the stress test exercises they perform. And they are quite doing this quite often, and they are stress testing different kind of events, and they're stress testing capital, they're stress testing liquidity of the banks. At the same time, it is not only something that supervisor can perform by himself, but it is also important for the bank management. Why? Because you all are familiar with such measure as return on equity, which is obviously important for estimation of the company. At the same time, in banking sphere, risks are even higher than in the real sector sometimes, and due to high leverage, the distance to default for the banks, it's even smaller. That's why in bank industry, it is important to estimate not return on equity in general terms, but risk-adjusted return on equity. And for this risk adjustment, the stress test is also useful. You can see how much capital does your institution, does your bank require, or some unit require, and the adverse movements in order to withstand all potential threats. And this is your so-called economic internal capital that you have to have in order to withstand these adverse movements. And evaluating the profitability based on this capital, not the one you have on the balance sheet, but this economic capital, you can allocate resources among projects and among business lines, units, and operate your activity in the most efficient way. That's why stress test becomes important not only from the supervisor point of view, but also from the bank point of view. And it also can be partially used for the evaluation of projects within banking institution. And this is why we insist on stress testing stress test to be used not only from the national bank point of view, and in order to decide on the regulatory requirements, but also we insist that institutions have to use stress test for internal risk management procedures. What we do from our side, we perform stress test each year. The actual exercise, which was really important, started in 2015, and it was really challenging and important at that point of time. After that, we had some break, and now we are conducting so-called diagnostic study each year, and this is the second one. In 2019, we perform stress test of the 29 largest banks. We select the banks that are largest based on amount of assets weighted on risks, and also based on amount of retail portfolio, lending portfolio, and deposit portfolio. We pick this criteria in order to select the banks that are the most important for the industry and for the sector. What we stress test? Three main types of risks. First one is credit risk, which is possibility that your borrower will not be able to serve debt or just refuse to serve debt. That brings credit risk for the bank, because bank doesn't receive any income, or at least not all full amount of income and debt from the borrowers. The second important risk is interest rate risk, which arises when the interest rates on liability side of the balance sheet increases higher than interest rates on the asset side of the balance sheet. It decreases the interest income, net interest income of the bank, and it also brings some problem. And the third one is foreign exchange risk, which is obvious when we consider the net open FX position of any bank or corporation. At the same time, it also has implicit influence through the quality of the borrowers, because if borrower earn money in Ukrainian hryvnias and have to serve that in foreign currency, it brings additional debt burden in case of some adverse movements. That's what we are stress testing, and our horizon for stress test is 3 years. Why? Because we have to see the full impact of the crisis event. So the first, second year, it's like deep crisis, and after that, it's recovery. And some banks actually recover in the third year, but some banks, unfortunately, they can't under our stress test. What is also important, that stress test is not by itself an activity to value the bank, to forecast its performance. It allows you only to reveal risks and to measure these risks for the bank, but it should not be perceived as kind of valuation procedure explicitly. That's why we encourage people not to compare banks based on stress test results, but use it primarily to see the potential risks. Probably the next slide, I start with the structure of our modeling process. So we have the so-called bank model, which is probably familiar for all of you. When you just forecast, make projections of the P&L and balance sheet statements, we do it for 3 years on the baseline and adverse scenario. It is annual, so we don't have higher frequency, just 1 year, second year, third year. And the capital, which is amount of buffer bank has to have in order not to breach our requirements even under adverse movements, it is also calculated here in this model, which is quite simple and straightforward, and I will continue with some details later. We also have one very important block, which is called individual large borrowers stress test. We pick up the largest borrowers of corporates of each bank, and we are performing the individual stress test of their financials. We are calculating the operational cash flows of those borrowers under adverse movements and under baseline scenario, and check whether they are able to serve debts, which we have. We usually do not change the amount of debt under stress test, whether they can serve debts with operational cash flows they have based on our assumptions. And if they can, they continue to become so-called performing borrowers. If they cannot, they become so-called NPLs, which is non-performing loans, which brings credit risk for the bank. Second, satellite model is a model for scenarios development. And here we assume, make our assumptions on stress test, on macro variables. And the last one is portfolio NPL projections. NPL is non-performing loans. So here we project, here we assess the potential fraction of borrowers that will become defaulted or non-performing from all other sectors except these large exposures under our assumptions on macro variables changes. So macro scenarios. We have, as I mentioned, two scenarios. The first is baseline, the second is adverse. Baseline is built almost 100% on our public projections of forecasts of the NBU. What we do not use is we do not use any kind of NBU's projections on FX exchange rate. We take this from focus economics because NBU doesn't provide any kind of forecast of exchange rate. That's why our baseline scenario is kind of combined. At the same time, our adverse scenario is built primarily based on a statistical approach. We take one standard deviation from baseline downside in order to calculate the potential change in real GDP. That's why we just take baseline and one standard deviation, decrease it by one standard deviation of the real GDP, and we understand our potential decline in real GDP in adverse scenario. What we have for exchange rate, it's like first shock. The second important shock is foreign exchange. Again, we take some average estimation of the currency depreciation during the previous crisis. As for now, our foreign currency, this shock is not so severe. It's moderate, I should say, because it's a little bit lower than even we experienced during 2014-15. And as for now, it's 23% depreciation of Ukrainian hryvnia during the first year and a little bit after that. These two shocks allows us to evaluate the potential consumer price index and inflation because we have all the parameters of transition of these two shocks. First of all, exchange rate shock on the price level. That's why we use these parameters from the baseline model and we project the potential change in CPI. That's why inflation goes up. And obviously, understanding that inflation is going to go up, we also understand that interest rates should also increase. And interest rates increases in our model, first of all, for liability side. So on deposits and other liabilities of the bank. And everything is consistent. So we are checking consistency in general terms with our colleagues from Monetary Policy Department, and we are checking whether baseline and adverse are built on the same general assumptions on these transmission mechanisms. And as soon as we have these macro assumptions, we imply some changes in financial sphere, and the first change is credit risk, which arises for banks. So where from does it come? It comes from the decrease in amount of income for households. It is driven by increase in nominal wages for corporates, and also it is driven by some decrease in gross margins for businesses. And we evaluate all this based on historical data and on our models. But the first issue which happens due to these adverse movements, it's increase of defaulted borrowers. The second problem that arises for banks in case of crisis is increase in so-called loss given default. What does it mean? That if we can assume that borrower became insolvent, for example, so it cannot serve his or her debt, but at the same time, if bank has some kind of collateral, it can potentially foreclose it and cover at least partially the losses. But under the crisis, usually, there is no enough room, first of all, to foreclose all collateral because there are some problems with this. And secondly, the price of the collateral usually goes down, which we faced, for example, in 2008 when the price of the apartments which were a collateral for mortgages at that point of time. The price for this collateral declined, and it actually increased the losses of the banks. We are trying, and this issue is even more important when we have loan nominated in foreign exchange and collateral which is actually priced in hryvnias. in this case, the loss given default, so when borrower defaults, the losses become even higher for bank. And this is assumed in our model with, this is controlled in our model with the use of this minimum at LGD. So we set the minimum level of loss that banks face in case borrower become insolvent or defaults. And this level depends on the currency and on the segment. What else? Interest rate risk, which was mentioned. So the liabilities, price of the liabilities for the bank increases, especially those of short term, because they are repricing much faster. And the price of the assets, in our case, we just stabilize it on the level of the reporting year. Why do we do that? Because it's much simpler to model, and it doesn't give you any side effects. So sometimes we use the most straightforward assumptions in order not to have side effects. Because as soon as we allow interest income on assets and interest rates on these assets increase, we can have a different set of results based on the bank's prices on the assets and the composition of the assets, which is something that we would like to avoid. And the last risk is foreign exchange. Explicitly, it influences the net open currency position, but implicitly, it also influences the quality of the borrowers, which is driver for our large exposure stress test and also our portfolio credit stress test. And also it influences LGDs. Credit risk. We separate portfolio of borrowers into two huge subgroups. The first one is large exposures, which are the largest corporate borrowers of each bank. And the second group is portfolio. Regarding that, after that, we perform stress testing for both groups based on different principles and receive the amount of borrowers and amount of loans that become non-performing on the stress test in each year of the exercise. Large exposure stress test. So the first step we make, it is even made before the actual stress test exercise. We cluster the industries and borrowers. We understand the general set of largest borrowers. We cluster these industries in order to make assumptions for each of these. So, for example, there is a separate cluster for sun oil producers, because we have several really important borrowers of the bank which work with sun oil, which produce sun oil. It's sunflower oil. And at the same time, we, for example, have one big cluster for another agri. So the clusters can be not equal in terms of wideness of the industry. And after that, we made separate assumptions on each of these clusters. So for amount of production, we took the same assumptions as we took for real GDP. So the statistical decline of the production based on baseline level and standard deviation, one standard deviation below this baseline level. That's how we assume that the production will decrease. Regarding prices, we use something close to value at risk. We take historical prices, especially regarding the prices on exported goods. We take historical historical data and estimate some kind of value at risk with different levels of confidence, and we make this as an input assumption for our diverse scenarios. So after that, we combine assumptions on revenue of the borrowers, so our assumed growth of the revenue, and we compare it with the assumed growth of the cost of goods sold. And we also check these gross margins on the general level of consistency. So in stress test, it is possible that due to exchange rate depreciation, it is possible that for some exporters, the gross margin can even rise. But for majority of clusters, the gross margin should potentially shrink under adverse movements. So we check this, and there are some also space for expert judgments. As soon as we receive all this input, I mean, we can perform the stress test, and in order to do this, we collect financials of the largest borrowers of each bank for previous 3 to 5 years, and we make projections based on our assumptions, and we calculate the cash flow from operational activity. And as soon as this cash flow is sufficient enough to cover at least debt service costs, the borrower remains solvent under our stress test. As soon as this cash flow is not enough to cover the costs of the debt service, this borrower becomes insolvent, defaulted, and it brings credit risk for the bank. At the same time, we are reevaluating the collateral if bank has some, and also we can increase the LGD for these large exposures. Regarding portfolio, everything is not so detailed. We just take historical data. We regress historical data on the macro assumptions, first of all, on the macro data. So we regress, for example, fraction of non-performing loans in corporate segment in Ukrainian hryvnias. On, as you can see from the slide, for example, we regress it on unemployment rate, on real GDP rate, on CPI, on nominal wage, and we are trying to obviously estimate the best possible regression equation. So we use lagged variables because usually the influence is not it's not immediate, and we are checking these models based on the usual procedures, and we receive the coefficients that we can further use in order to estimate the same NPL fractions, so non-performing loans fractions, under adverse movements. And you can see from this slide that, for example, for corporates, our migration to non-performing loans are moderate. So the 3.5% of total exposure during the first year of adverse scenario. And for example, 4 during the second year, which is quite moderate, which is comparable even with what unfortunately we observed during even previous year. So corporate portfolio of the rest of the borrowers, except large, it is quite resistant to adverse movements based on historical data. At the same time, what we have for individuals, for retail portfolio, unfortunately, it's much worse. We use the same approach. We regress based on the macro variables and based on our assumptions on adverse scenario, and we receive a huge migration of retail loans to non-performing. This year, the total cumulative migration of working loans to default loans for retail so-called consumer loans, which are not, which are taken for general purposes and do not have any kind of collateral, the migration of these loans was 20%. So one-fifth of the portfolio just go to default, and bank actually doesn't receive almost anything from these loans. And again, it can be a little bit difficult to understand from this graph, for example, and probably there is possibility that someone can say that we have two adverse scenarios, but unfortunately what we have seen in history, it was comparable. That's why our stress test on retail is quite severe. And regarding LGDs, as I mentioned, we assume that in case borrower defaulted, for retail portfolio, for example, in hryvnia, at least 85% consumer loans, at least 5% of the loan will be lost by the bank. This together combined into our understanding of level of loss from provisions. So banks have to make provisions for all these losses, and as soon as we calculate losses, we increase provisions of the bank, and it decreases financial result. The next shock we estimate is from interest income, from interest rate changes. I mentioned it before. We assume that in general the liability side is the repricing there is much faster, especially for those liabilities deposits that are short term. We understand like short term is when it's less than 6 months. We increase the interest rates on these deposits even higher, but in general we increase the whole yield curve, so-called, so we increase the prices for all deposits, but for short term even higher, because as soon as the deposit is the term is over, and in sphere when the interest rates increasing because of inflation, probably the bank will have to provide higher interest rates in order to maintain borrowers, to maintain depositors. This interest rate shock, first of all, it obviously decreases net interest income of the bank. So we again have the full impact in P&L. The interest rate income, net interest income decreases. And together with provisions, it brings potential losses for the bank. And there are some other items of the P&L we also try to model, but they are kind of side ones, so they usually do not make huge impact on the performance. What is important, for example, that we also assume based on the GDP, nominal GDP growth, we also assume some changes in commissions, in fees, and also in income, both income and loss and expenses, and also we assume some growth in administrative cost. Somehow, sometimes, for banks which are not really operationally efficient, this brings higher risks than even portfolio provisions. That's why this effect, it seems to be side one, but usually sometimes it is really important and brings losses for the bank. And these assumptions regarding the growth were fully built on historical data for the banks we actually stress tested this year, and including both crisis and not crisis periods. When we combine all this together, so we see the full impact in P&L. We have change in net interest income. We see the changes in provisions, which are loss usually. We also see some minor changes in other items. And we also have FX revaluation, which is driven from, based on net currency position. And combining all this, we can calculate the potential loss during each year of stress test for bank. And as soon as we get it, it is directly influences directly the capital of the bank. And capital ratio, capital adequacy ratio, is one of the most important issue we calculate in stress test, and probably the one final which brings our attention. Capital adequacy ratio is the capital divided by amount of assets weighted on risks. We do not change much the denominator, so risk-weighted assets, they are changing only on provisions because they are net of provisions. So as soon as bank make additional provisions, the denominator can decrease. But we change a lot capital, because as soon as bank get losses, these losses just should be taken from the capital, and that's why the capital usually decreases in adverse scenario of stress test. This is capital adequacy ratio decreases. That's what you can see from the slide. In this case, which is just to illustrate, the capital adequacy ratio at the beginning of the period was 8%, which means that capital was at 8% from risk-weighted assets. During the stress test, due to all factors which I mentioned, First of all, due to losses that bank earned, the capital adequacy ratio decreases, and it decreases up to 1.6 in second year of stress test. And what we do next, we understand that in order for bank to maintain the capital adequacy ratio on the required level, which in this case threshold is 3.5, so we require from bank to have at least 3.5 capital adequacy ratio even under adverse scenario. As soon as bank breaches this threshold, we calculate this so-called delta, so the red bar, the difference between the threshold and the actual calculated levels of the capital adequacy ratio. And this delta should be held by the bank additionally to the current level of capital in order to go through the crisis, this modeled crisis, without breaching the threshold. In this case, we add this maximum decrease from threshold to level that banks had at the beginning, and our required level of capital adequacy ratio in this case will be 9.9%. While, as you may know, this is example for core capital, so-called core capital of the bank, which is not seen from the balance sheet. It is a regulatory measure. And this core capital minimum requirements, which are set by the regulation, is 7%. But in this case, the bank will have to hold almost 3 percentage points higher ratio based on stress test, and it will become our requirements for the bank. And as soon as we give this information to the bank have to fulfill the kind of capitalization or restructuring plan in order to reach this level. And we have a deadline for this procedure, which is this year it will be almost 1 year. So bank have 1 year in order to reach this 9.9% capital adequacy ratio. Just to conclude, what we hope to get from stress test. First of all, we hope that it will show the most vulnerabilities of the banks to themselves and to us, and also to other interested agents from different spheres. We also hope that it will allow us to set and understand on the same rules on credit risk assessment, on foreign exchange risk assessment, and also interest rate assessment. Because we are going to ask starting from next year from banks to perform stress testing, and this how we see this exercise. And we are trying to communicate with banks and also with auditors who perform the first stage so-called asset quality review in order to see some drawbacks in this methodology also, and in order to set the common practices for the banking sphere. And in general, after all, we also expect that these requirements for higher capital in order to cover risk will allow increase the financial stability of the system as a whole. I think this is all I wanted to mention. Thank you, and in case you have some questions, I would be glad to answer them.
So, first of all, thank you very much for such a great presentation, and I encourage the audience to have some questions. So please, gentlemen.
Hi, thank you for presentation, very interesting. Oh, sorry. I have actually two questions for you. First one is more practical. Let's say we are as external party, right? We are like investment analysts. We are trying to make a stress test for the bank without having all that information that you as a regulator have. Can we do at least I don't know how to say it better, but the stress test to at least close to same quality as you do? This is the first question. And the second one, you just mentioned that you give a bank 1 year to make that recapitalization happen. For me, it seems like very long period. Anything can happen in 12 months, right? How do you think maybe this period should be shortened somehow? Thank you.
Thank you. Actually, great questions. I probably start from the second one. And yes, we actually do that. This is too long also. And that's why we are somewhere in our way to the most efficient procedure of stress testing. We started in 2015, and that was another kind of system, and we had to give even more time for them to make all the changes, because a lot of banks were suffered really great big decrease in all possible measures, and they had to have this time. Previous year, the time we gave to the bank, it was a little bit longer than 1 year. And we asked them not to make the capitalization, so just bring capital and that's it. We also asked them to make so-called restructuring of the assets. So as soon as you can somehow sell or I don't know, do something with bad assets, you have some time to do this. And it would be even better than just bring capital. Sometimes it is really even better. And that's why we gave some time, even longer period of time, in order to perform this. This year, we can see that majority of issues at some banks have already been solved, and there is no need to give so long time. But still, there are some technical difficulties. For example, just in order to bring capital, you know that in order to bring capital, banks have to go through some official procedures, and it's not so easy. So we have at least to give some time. But what we understand for the future, that this time for fulfillment of the program is going to be smaller and smaller and smaller. And in general, as we've seen it from the beginning, the program and capitalization should be fulfilled till the end of the year of the stress test. So we are performing the stress test based on the data on the 1st of January, and the full program should be fulfilled, and everything should be covered till the end of this year. This is how we see it in the future. And I hope that we are going to be more strict in that, because previously we have some issues with just technical issues, because bank cannot bring capital just for 1 day. And also we gave this time in order to make restructuring. But as with moving forward, we understand that this time can be potentially decreased. Regarding the first question, some information, not for individual borrowers, for example, but some information with quite interesting details, it is provided either in financials of the bank or in our regulatory data. And there is special on our website we have special link to so-called Supervisory Statistics, where some interesting figures can be found, and there is, for example, information on the quality of the assets, loans of the bank. So you can see the portfolio and how much non-performing loans does the bank have, and try to understand the potential flaws of this structure, and try to make kind of stress test. Obviously, it will not be probably, it can be questionable. I mean, it depends on the assumptions a lot, but regarding the quality of the portfolio, at least, in general, you can receive this information from the regulator side, from the NBU website, and regarding the financials, you can receive a lot of information from financial statements. So in general, I assume that you can try to perform such kind of estimates by your own, even based on available data. What you should be probably cautious with is that this is not going to be some kind of measure that can be used in order to rank banks, for example, who's performing better or worse. It's just an exercise in order to reveal the weaknesses of the institution, not to rank them one against another or something like that. And we are also trying to provide as much information. In future, we are going also to provide new information regarding the banks. There is also this FinRep figures, And further, we are going, which is financial reporting of the bank. This is a European standard of financial reporting, and also COREP figures, which are more supervisory information from supervisory side. And we are going to provide more and more information so that potentially in the future you can make even deeper analysis on the bank. So I assume yes, somehow.
Thank you so very much for the presentation. You mentioned that one avenue to proceed to comply with the stress testing would be to get rid of toxic stuff from the balance sheets of the banks. And if they do, that would obviously mean that they will have to post losses, right? So do you anticipate any volatility of currency exchange rate if bank starts posting losses when selling off the assets with discounts? Thank you.
You know, the situation is kind of, we do not, what we actually can see from the figures and from the results of the banks, that there are some toxic assets, but usually they are not provisioned in full, which gives this negative impact for the bank. But majority of these these toxic assets, for the majority of them, banks just have to say explicitly and have to cover them with provisions and say explicitly that it will potentially get nothing from them. So it's not even question of selling something, because sometimes banks are able to sell something, but it is not question of some kind of fire sales or something like that. It's just a question of say truth to themselves and just provision almost the full price of their assets. Sometimes, usually, the major effect it brings, it is brought from this as toxic assets which cannot be even sold because there is no value, and there is usually no collateral that can be foreclosed. So it should not have any significant impact on the real estate market, on commercial real estate market, or something. It is more about the provisioning. And unfortunately, in order to do this, banks obviously have to show losses in the P&L. Some banks do not want to do this, and sometimes there is a need for capital they should take from the owner. And this can be questionable, but finally this is something that should be done. And now we are somewhere probably in the process of understanding that this is what is actually these toxic assets should bring on the table. And regarding all other potential, like mortgages, for example, there is also not should not be so a significant impact on the market, because usually banks are dealing, and even now they're dealing with these toxic assets and performing quite well. So it's a matter of time and it's a matter of efficiency. So they should also sell them to someone who can do it. And this process is ongoing, so you don't see, I assume, any negative impact on the real estate market, for example.